Hey guys, welcome back to our channel. Despite its best intentions, Bitcoin and other cryptocurrencies are no longer the discrete and anonymous digital assets they used to be. Paying our crypto tax, while complicated, is a necessary process that protects you from difficult situations with regulators like the IRS down the line. It's no secret that virtual currencies like Bitcoin and Ethereum are witnessing exponential adoption worldwide. Unfortunately, cryptocurrency tax reporting is still a mystery for taxpayers. Are all my profits from crypto trading counted as capital gains or ordinary income? Do all my cryptocurrency transactions count as taxable events? This crypto tax video guide will answer all your basic questions and hopefully prepare you for the next tax year. Don't forget to subscribe if you like our content and would like to see more. If most of your crypto activity happens on Binance or Coinbase, you shouldn't have too much trouble. These large crypto exchanges provide plenty of comprehensive tax forms, documents, and tools that simplify your tax preparation. However, the world of blockchain and crypto assets is a deep and dark rabbit hole. The deeper you go, the more complicated your tax return becomes. If you're actively involved in DeFi, you're probably earning extra taxable income through stakings and airdrops. What's more, not every trade is as simple as swapping fiat currency for crypto. If you're flipping NFTs or trading crypto to crypto, you must always keep records of your purchase prices. Calculating your holding period is also crucial because that can influence whether your profits will be considered short-term or long-term capital gains. Finally, every country is different. There is no global crypto tax software or income tax rates. What is true for the IRS in the United States is very different from what you can expect in Dubai or Singapore. Given that the United States has some of the highest adoption rates of cryptocurrency in the world, the rulings of IRS are often followed by local taxation entities in other countries. According to the IRS, cryptocurrency is considered a capital asset, like property. What this means is that any crypto gains or losses need to be treated as a taxable event. In crypto trading, this is deemed a capital loss or capital gain based on whether or not you profited from the event. On the other hand, any cryptocurrency earned from staking, mining, or airdrops is treated as income and is subject to income tax. This includes any crypto acquired from network hard forks, as we saw during the Ethereum merge. Now, if you're looking at your wallet history and starting to panic, don't worry. Some crypto transactions don't need to be registered on your tax filing. These are the common activities that are not treated as taxable events by the IRS. Purchasing virtual currency like Bitcoin or Ethereum using fiat currency. Moving crypto between your own wallets. Donating cryptocurrency for charitable reasons. And offering crypto to others as a gift. Any crypto gifting under the value of $15,000 typically has no tax implications for the gifter. However, if the receiver chooses to sell the gift, that will be considered as taxable event. It's essential to keep records of the asset's fair market value and the gifter's purchase price. Donating crypto to a charity is a great way to spread goodwill and makes the donor eligible for a tax deduction. This deduction is typically equal for the fair market value of the capital asset at the time of the donation. So, apart from the few exceptions listed before, most transactions, whether on cryptocurrency exchange or in DeFi and NFTs, are taxable events. These include, but are not limited to, selling crypto for fiat currency or trading one virtual currency for another, paying for goods and services using cryptocurrency, earning crypto through mining, staking, or airdrops, getting your income paid for in cryptocurrency. Like in traditional taxation and finance, the amount of crypto tax you are required to pay depends on how much you have gained through income and capital gains. For assets that you have held for less than 1 year, short-term capital gains or losses will apply. If you have hodled for over 1 year, your assets will be treated as long-term capital gains. Now, your tax bracket is determined by your overall income, with different rates applied depending on whether each taxable event is considered a long-term or short-term holding period. To give you an idea of what you can expect, TurboTax provides a helpful chart outlining the different brackets. TurboTax also offers a convenient crypto tax calculator which can help you save time filling out your IRS forms and ensure you complete your tax filing correctly. And no, we are not sponsored by TurboTax, though we could be. When calculating your crypto taxes, it's essential to keep track of your cost basis. Now, if you have bought the same crypto multiple times, you will need to apply the first in, first out method to calculate your cost basis. This means the first assets you buy are the first assets you sell when preparing your tax filing. Now, listen, what a beautiful world would it be if we only experienced crypto gains and avoided losses entirely. Unfortunately, no one has a 100% hit rate when crypto trading, and suffering a few red candles is inevitable. The good news is that you can declare your losses to reduce your tax liability. This is called tax loss harvesting and is a standard method for traders and investors to offset their capital gains tax payments. To get a better understanding of how tax loss harvesting works in crypto, take this imaginary example. You buy one Bitcoin at $20,000 and one Ethereum at $1,000. While you hold both assets, Ethereum pumps to $2,000 while Bitcoin falls to 19.5 thousands. You sell your Ethereum for $2,000, earning $1,000 in profit. You also sell your Bitcoin for $19.5 thousand, realizing a $500 loss. If you don't sell your Bitcoin and realize capital losses, you will need to pay capital gain tax on the $1,000 you earned trading Ethereum. However, because you have registered a $500 loss on Bitcoin, you can offset that loss against your gains. As a result, you only need to pay tax on $500 earned in your Ethereum trade instead of $1,000. Now, on the flip side, crypto taxation and regulations are under constant scrutiny and revision worldwide. Every country has difficult crypto tax laws that are prone to frequent change. You should always stay up to date on your local crypto regulation standards and consult a tax professional or certified public accountant when managing your taxes. Avoiding your crypto tax reporting responsibilities could land you in hot water with your local jurisdiction. Staying informed on how to pay your crypto tax correctly will save you a lot of headaches at the end of every tax year. Thanks for staying with me till the very end, and I'll see you in the next video.